Okay. And go ahead and pull it up. All right. Okay. Oh. Hope everybody's doing awesome this morning. We're just going to be looking up some new stuff and random stock things here and there. I've noticed that Tractor Supply is a company that's been pushed and pushed and pushed by news articles. And I mean, I understand why. There's a lot to love when it comes to this holding. There's a reason it's on my watch list. Let's see what they are saying about it, though. It's kind of been stuck in this up, down limbo area for over a year now. Going on 2 years. Yeah, it's been around this price for a while, so it's definitely been prime time to accumulate shares. This is one I wouldn't mind seeing actually tank. Because I would love to take advantage of it at even a lower price. The payout ratio of this company is silly good, and it's got over 2% payout, a dividend. Really like what I'm seeing here. Alright. Yeah, it's got an adjusted free cash flow yield now above 3%. And usually above 3 is pretty good. That means there's genuinely some value there. Good morning. What's up? I have seen the yield in recently though, like a good little bit above 2%. So I would. It dipped into the high 180s at one point. I would love to see this thing in like the 170s. That would be prime pickings, I feel. But yeah, good consistent revenue growth. 11.7% over the last 10 years is nice. The free cash flow is right at 10% over the last 10 years. That's also very nice. I think they do share buybacks too, which is... Yeah, they do quite a bit of share buybacks, if I remember correctly. And they do it at good times. They usually buy shares when they're in a pretty modest dip. And that's reflecting with their return on capital employed because they're using that excess cash wisely. They have taken on a little bit more debt, but even whenever they did that, like they're already paying it down, so that is not an issue whatsoever. I really, really like this company though. Again, it's been one I've never just had the chance to fully pull the trigger on it. I know a lot of people are afraid of retail right now because the year that Dollar General's had and that Target has had, those have just had massive dips in the last probably around 2 years-ish now. Let's look at Target. Target's a nice rebound. This thing dipped down like the 105, 108 area, and it's already back up to 134. So if you would have timed that out properly, you'd already be sitting on a very nice like 20% gain with Target. And once this updates, it's actually going to show that they have positive free cash flow for this year too, because the annualized is showing negative, but they have had 3 out of their 4 quarters this year have been positive. So really, what are they setting at? 800 million, 900 million, that's 1.7 million, 2.2. So they had a negative 300 quarter. So it's like $3.5 billion in positive free cash flow, which is very nice. That it's a lot better than how they started this year. That is for sure. And they're paying down their debt some, which is something you always like to see. I don't know, it's just been a really tough year for a lot of retailers. And they say it's like theft is a really big issue that they've been having. I know Target, I think they were estimating, what is it, $500 million in stolen goods by year's end. Like that's a terrible analysis. Oh, Dollar General. The good story that once was. They're just having an awful year. And there's talk that their year, like this awful year, is just not over yet for them. Things are still not really looking all that good. Like they dipped almost under $100 a share at one point. Where's the bottom at? Yeah, they touched 101. They're up to 134 now. I mean, heck, that's like a 30 some percent gain right there. But I don't know if they can sustain this that bounce. There's just so many things in a wrong direction for them. But a lot of hedge funds are picking up Dollar General, which I found to be interesting. Let me look up super investor portfolios. There's been quite a few. Actually pick them up. I think I can type it in here. That should show it. Yeah, we had 6 super investors, quote unquote, have actually bought into Dollar General this last quarter, and 3 of them got pretty sizable positions. And one of them's a big name, Pat Dorsey. He got 3.7% of his portfolio is now Dollar General, and Christopher Bloomstrand, I don't know who that is, but over 10% conviction in Dollar General. Let's take a look at their portfolios. Just curious what they are rocking with. So Christopher Bloomstrand, we're just going to call him Chris, so I can stop saying that last name. So his top 2 positions, we got Berkshire A and Berkshire B. So that's what? That's 36% of 36% of his portfolio is in Berkshire. I mean, that's not a bad thing. Berkshire is amazing. Dollar General's next. Mercury General. I've never heard of that. MCY. Good morning, everybody. Hope everyone's doing good on this Sunday. Mercury General Corp. I have never heard of that in my life. Mercury General.
Mercury's an engine brand.
Is it an engine brand?
I don't know if it has anything to do with that company, but yeah, Mercury.
Financial services. automobile insurance products. So this is like an insurance thing? Weird. This company kind of looks like a mess, I won't lie. Their free cash flows everywhere, their EPS, their net income, their revenue's kind of growing. Dividend scares me. They did have a cut. Negative return on capital employed. Yeah, none of this screams good. None of this is good. Let's see what else this guy's rocking out on his portfolio, because that is not no good. We know what Berkshire is. No, Dollar General is. He's got Olin Corp. OLN. I think it's interesting just to like break down and see what all these literal billionaires are buying. Olin Corporation. Basic materials and chemicals. Okay. They've had 2 really good years back to back, it looks like. How's 2023 going for them? Pretty good, no complaints. Revenue's growing very nicely. It looks like they had a big hiccup in 2020, and they've kind of really got things back on track. I like that. Dividend has just been flat forever. They've literally not increased their dividend payout since 1999 was the last time. Okay, so this company's been around for a while. I see news articles here saying this is likely a value trap. I don't like that. Over the last 5 years, again, it's not really done much. It's kind of just zigzagged in this area for a hot minute. Okay. That's the thing that confuses me. I don't see what a lot of these like billionaires see in some of these companies they invest in. Like just looking at this right off the bat, Paramount would have scared me, but I guess they kind of rolled the dice correctly there, because Paramount and Apple are now talking that they're trying to sync up together, have Paramount be a part of, I guess Apple TV is what they're going to be doing. Alaskan Air Group, I just stay away from airlines altogether. Those are usually nightmare holdings. Again, not financial advice, not telling you what to buy or sell, but like, I stay away from these. I stay away from these hard. The airline industry is usually just a mess, and they can operate at a loss for forever, but because the government views airlines as a like essentials, they always fund them. It doesn't matter. Like you can be like, look at all this. They have negative free cash flow from 1990 to 2009. So almost 20 years. They had 2 years of positive free cash flow. 3. They had 3 years, and theirs wasn't even all that much. Yeah. Oh my gosh. And again, like, this is one that just doesn't make sense to me. It's all over the place again. But I don't know. Disney I like. Cummins I like. Cummins is, I feel, is a very underrated company as a whole. It's a great dividend stock. Disney did reinstate their dividends, so they're going to start paying out to their shareholders again. I think they're doing it semi-annually still, so it's going to be every 6 months, which, like, pay every quarter, Disney. What are you doing? Just cut it down into every quarter. Instead of 30 cents every 6 months, do 15. Make people feel a little bit better. And I know it's more of like a psychological thing than an actual something that's needed. Welcome. Good morning. Good morning. But I like Disney. I like Cummins. I like Starbucks. He got in at Starbucks at 91, it looks like. I don't know much about Dollar Tree, but I'm just assuming it's very similar to Dollar General with the way they're set up. Let me look it up though. DLTR. DLTR. I know they're different entities, but I'm just going to assume it's going to look... Oh my god, no, it's worse. Their free cash flow, this scares me. It's been in a downtrend since 2017. Ugh. That is none good. And they keep missing their revenue and earnings guidances, it looks like. Okay, so if I could like alt delete a company, not a company as a whole, but like just seeing these stats from my brain, I would. It's that bad. Okay, next up we got Equinar, EQNR. This dude's got a bunch of really random holdings I've not heard of. Positive cash, more cash than debt, growing revenue, growing EBITDA. ICE is an oil company. Okay. It's one of those USA. I mean, I don't own any energy. And this honestly looks a lot like Chevron's. The way that Chevron's is Qualtrim stats look. Here, let me put that side by side. I'm just curious because I'm having some deja vu moments right now. Chevron annually. It looks the same. It literally looks the same. I'm not crazy. Look at this. They might as well be the same company. I don't know. That's kind of weird. I thought that looked suspicious, but like it is literally like I copied and pasted Chevron into Equinox. The only difference is like everything with Chevron times 2. But it's the same pattern of growth and non-growth. Okay, let's go back to this cat, see what he's got. Oil and gas have great dividend growth for long-term investors. They do, and if you can catch them at the right time, I mean, I understand buying into them, but I feel like the prime time to buy into oil and energy was way back in 2020 when it was like $- a barrel. You could get, what was it? We'll look here on the chart over the last 5 years. So the 2020 dip in oil, the big scare, Chevron dipped to $54, which is very nice compared to where it is today. I just think it's too volatile for my liking. It's as you see here, their revenue streams are up and down and up and down, and the free cash flow should be the same. Yeah, up and down. They have negative years and positive years. And yeah, you do get some nice dividend growth and stuff. Like, I get that, but it's personally not for me. I like consistent, something that I know is going to just keep going up, and I don't have to worry about really any economic factors impacting things. I'll show you an example. Texas Roadhouse is one of my bigger investments in my portfolio. Look at this consistency. It's just each year up and to the right, up and to the right. Even through the dot-com bubble in the early 2000s, still up and to the right. The financial crisis from 2007 to 2009, they managed to still grow through that. Their only dip year was COVID, and that's because like every restaurant in the United States was shut down. So a lot of them, were hit very hard, obviously. But after that, they went right back to where they were and increased even over 2019 and 2021, 2022. And if you look at their free cash flow, very similar story. Up and to the right with everything. EPS, you're going to see the same thing. And they have really, really good debt management. That's another thing that I absolutely love with Texas Roadhouse. Zero debt. That's amazing. It's the reason I love them so much. The same reason I like Ulta so much is they don't have any debt on hand. And return on capital employed is beautiful. Look at that. It's growing. I don't know. I'm just a sucker for Texas Roadhouse anyways. It's such a good stock. There's so many things to love about it. But I mean, I get what you're saying with the oil and gas companies. And they usually pay higher dividends. So if it's someone that they're already retired and stuff, they're not looking for all that much growth. I get it. Blah, 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 blah. Okay, let's go back looking at this guy. Another energy stock, ExxonMobil, semiconductors, Merck Company, and then things that are less than 1%. Costco, General Electric. General Electric's been on a run this year. Oil and gas beat the S&P 500 or tie the S&P long term. Maybe? Do they? All right, let's look at the dividend reinvestment calculator I got here. ExxonMobil. I mean, it's right in line, yeah. ExxonMobil over the last 24 years. Annual growth rate 9.74% with dividends reinvested. And I mean, this is a prime example of like dividends do matter, because if you look at it without dividends reinvested, the S&P 500 is actually winning, but with dividends reinvested, it adds almost 2% annually to ExxonMobil. I know another popular one's EPD. We'll look at it over long term. EPD's crushing. Look at that. I've seen a lot of people hold EPD. And a lot of people really love it. It's got a really nice dividend. And I think they've got like, what was it, 27 or 28 years of dividend growth with EPD. What's another popular one? I think let's see what's Chevron's. Is CHV or whatever? CVX. We'll put that in the drip calculator. CVX. For anything you want me to look up in here, let me know. Yeah, again, the very similar situation with ExxonMobil. Without dividends reinvested, S&P 500's beating it by a little bit, but with dividends reinvested, it adds about 2%. So, I mean, yeah. Over the long term, it is market beating. You are absolutely right. I mean, this just goes to show, like, the power of just dividends in general. You cannot downplay them. It's too good. I mean, let's even look at, like a sin stock, like Marlboro brand Altria. Let's compare that to the Microsoft. Oh, yeah. I mean, even then, 13.5% dividend with dividends reinvested since 95. Microsoft said, oh my God, look at that. Almost 18%. That's silly. Silly. Look at it from 99. Oh, it's a bit closer. Yeah, Microsoft was hit super hard during the dot-com bubble. That just demolished that company. But they're back on track, and they are just... it's probably going to end up being the #1 company in the world. Would not surprise me whatsoever if they end up passing Apple up here soon. What's everybody into this morning? It's Sunday. Got some football coming on here in a bit. Anything yins are looking into in the stock world? This is my watch list I've got currently going on. I've got my eye on John Deere, as well as another one I've been looking into. They've said that next year is going to probably be really rough for the company as a whole, but I am long term on them, so I am watching to see if we can get some really nice dips or not. Go Packers. No. No. Jordan loves, I kid. Jordan loves this neat. He's a pretty good successor to Aaron Rodgers. He's not an Aaron Rodgers, but I mean it's not a bad pick. Well, you've been into Hubs. Hopefully you've been doing well over there. If there's anything you want me to look up in Qualtrim, I've got a dip calculator here. We can look at things over a certain period of time. And I've just been looking at some super investors, what they've been doing. You hope he pans out? Man, I hope Kenny Pickett pans out for the Steelers. That's what I'm hoping. He's been doing well so far. He's like the most... He has the most ball security out of anyone I've ever seen. He doesn't throw that many picks, but like he doesn't really pass the ball a whole lot. Like when the Steelers win, they win by like 3 points. All their games are just so stressful to keep up with. I'm just like, oh no, we're winning, we're losing, we're winning, we're losing. It's yeah. Baby hands. I like him. They need to nail the... Yeah, they did get rid of their offensive coordinator, I believe. I don't know who they can get. Like, the Steelers had such a good formula for so long. They were really big into, like, trick plays and stuff. And I feel like that was kind of like their thing for a while. Especially back in the days of, like, Randall L. Like he was one of their receivers and their kick returners, but he was a quarterback in high school and college, I believe. And like that man had an arm on him. The Super Bowl, I think it was the Steelers versus Seahawks, and they did a reverse, and he threw that touchdown pass to Hines Ward. My goodness, too good, too good. Looking at PKG. Well, you can take a look at PKG. PKG. Packaging Corporation of America. Like how the name of that is. They're up 31% year to date. Let's look over 5 years. They're pretty much right back where they was 5 years ago. Well, 5 years ago. At their recent high. Back in 2022. Revenue, I like that. 11% growth over the last 10 years. Free cash flow, 9.3% over the last 10 years. What is adjusted for stock-based comp and buybacks? Okay, so they're doing buybacks too a little bit, looks like. EPS, that's silly. 20.5% growth over the last 10 years. Debt to EBITDA, 2.4 debt, 1.4 EBITDA, so that's also, I don't mind that at all. I didn't know you were a Steelers fan. Oh, I've been a Steelers fan forever, man. I remember when we drafted Ben Roethlisberger back in 05. I think it was 05. Very happy about that. It was either 04 or 05. I don't remember what his first year was, but yeah, him, Jerome Bettis, Deuce Staley, all those guys. You're watching Young Brands? I will absolutely look them up in just a second, Sean. No problem, buddy. Dividend 12% over the last 10 years. There's a lot to like about this. I've not heard of them or looked into them. This is my first time seeing it. Consumer. I mean, the adjusted free cash flow, you have 3.55%. I mean, it doesn't show that it's tremendously overpriced. So, I mean, I don't know. It might be something to put on the watch list and see if there's any significant dips going forward. PKG. Yeah, I'll throw it on there. Why not? Yeah, I mean, I don't hate anything about it. it looks like it's got a really good track record of growth in revenue, free cash flow, everything. There is a rich history of the Steelers. Do analysis on Yum Brands. I will look that up for you now. Yum Brands. I looked into the history of Yum Brands. That's, yep, KFC, Pizza Hut, Taco Bell, and Habit Burger Grill brand. I haven't heard of them. But interesting enough, I think Pepsi used to own like Pizza Hut and stuff back in the day. And they spun off and made their own thing with Yum Brands. Let's take a look here, see what we got going on. Year to date, flat over the last 5 years. Looks like it's kind of hovered in this zone. Anywhere from $107 to $140 a share. It looks like it's just kind of been zigzagging for a little bit. Just a free cash flow yield 3.39%, not bad. Just dividend yields 1.9%. A low payout ratio 11.5%. Okay. So they have this drop off in 05, so I'm going to change this to 5 years. Pretty nice little 10% growth over the last 2 years. Okay. Free cash flow. The free cash flow has been pretty flat, it looks like. Yeah, not too much action going on there. Since 2017, though, they are growing, which is nice. EPS, 3% over the last 10 years. Sure, the 2020 has probably thrown us off a little bit because, yet again, everything had a 2020 dip. Their debt, $10.5 billion. EBITDA is $2.3 billion. So that's a little bit high. A little bit of a red flag for me there. Their debt, let's see. Their debt right now is $11 billion. We can actually calculate this up here. Now, let me get a calculator out. They had a quarter of 550, another one of 595, and another one 633. So let's say they fall in line with that. Let's say it goes up just a little bit, or we'll do the same thing. 633. So it puts them at 2.4 billion estimate. Their debt was 11.15, 2.4. So their debt to EBITDA ratio is a little higher than what I personally like. I like this to be around or below 3. Theirs is at 4.6. So I mean, it's not crazy high, but it's still a little bit higher than what I personally like. The dividend's been growing at a rate of 8.56% over the last 10 years. So you got some nice inflation beating dividend growth, which I mean is ultimately the deal when it comes like what you want from any of your holdings, because inflation's supposed to be around 2.5, 3-ish%. So you want your dividends to be going up. You want to be getting paid more than what the economy is charging you to live. Shares outstanding. Ooh, they are buying back shares. It looked like there for a good bit. I like that. I do like that. They're at 286. Oh yeah, they bought back a good chunk. Good chunk in 2023 so far. So they're probably taking advantage of the share price going down. That's probably going to reflect on their, oh my goodness, that return on capital employed. Look at that. Usually the market average is like 9-10%. Yum Brands is like 35, 40, 50%. There's a lot to like with it. I love restaurant stocks. I'm really big into them. Another one I like is DRI. That's the Olive Garden company. And Cheddar's, I believe, is another one that they have. But I mean, there's a lot to like with this, especially if you're looking for a restaurant stock for your portfolio. Not financial advice, obviously, but like, I mean, yeah, I like them. CapEx. Let's look at CapEx. Not bad. Okay, yeah. So they're not having to spend out a bunch of money to make a bunch of money. That's what their capex would show. PKG is on my watch list. Good to see some positive metrics there. Oh yeah, there were some pretty good metrics there. DPZ. Okay, we can look at it. I think that's Domino's. I did a little bit of a quick trade with Domino's earlier this year. Yeah, it was down in here. I got into it in the low 300s, and then it shot up. I got out because I was like, oh my god, I got like a 25% gain in this thing in less than 2 weeks. But Domino Pizza, let's see here. We'll look at them over the last 5 years, 49.3%. They're down still from their all-time high. They've never really recovered. December 2021, we're looking at 562 a share, down to 397 currently. They did have a dip recently. If you could have jumped in this into the 300s, that'd been real nice. Dividend 1.22%, payout ratio 32%, free cash flow yields over 3, so not too bad there. Revenue, I will absolutely do that. Let's see here. All-time revenue over the last 10 years, 10.46% growth. Not too bad. Nice double-digit growth. Free cash flow, 9.28% over the last 5 years. Okay. Do they have stock-based comp? It's not bad. Okay. That's always a fear when it comes to really any company, is if they've got positive free cash flow, but their stock-based comp is just, they're giving out more than what they're making. EPS is silly. I'm pretty sure it probably has something to do with share buybacks. I know that DPZ does a lot of share buybacks. Let's see here. Their debt is $4.89 billion. Their EBITDA was $848 million. So it's, again, I think that's pretty high. But I know Domino's always carries a lot of debt. And they use that for like share buybacks. If I remember correctly, they really chop at their share count. Nope, I did a math wrong. Let me try that again. Divided by 84. So yeah, their leverage 5.86%. So it's a little bit higher than the last one we looked at. But again, they always usually carry quite a bit of debt to EBITDA. The dividend, silly, 19.72% growth over the last 10 years. That's pretty good. And I already knew it. The shares outstanding, they buy back their shares like crazy. That's just, Domino's has always done that over the last 10 years. 4.79% average. That's just trickling down. Which, I mean, you'd like to see it. They're at 36 million shares. Let me see quarterly so we can see this updated. 35.36. So, I mean, are they looking to possibly do a stock split? Because, I mean, they keep buying back their shares and buying back their shares. Eventually, you know, if there's nothing else to buy back, what are you going to do? You're gonna have to do a stock split. And if this company did a 1-to-4, I don't know. I think it'd be pretty good for them. You know, personal opinion. And the return on capital employed is silly. This is 60s and 70%. That's nuts. I'm surprised they got a low beta, 0.84%, 0.84. I thought that would be higher. I mean, Domino's, I like them. Good pizzas. DPZ beats the S&P 500 over long term by oh, absolutely. Absolutely. They crushed the S&P 500 over the last 10 years, 478% growth. Silly good stuff. So we got another request here. Polar Power. Okay. Let's see what we got going on here with Polar Power. They are down 64% year to date. They have had negative free cash flow every quarter. Since 2019, they have bled money. Not good. Net income's negative, and the company as a whole only has $296,000. Yeah, this is getting wrecked. Polestar, the next big EV stock.
What's the date on that?
May 11th this year.
Oh yeah, I don't think that's gonna happen.
Yeah, this is all bad. All bad. Oh. It's pretty scary. But yeah, ultimately we want to fill our portfolios with those good old market beaters. I genuinely like to try and find companies that have 10% plus free cash flow growth, good revenue growth, and I think it just falls in line. If you got a company that generates good free cash flow, their stock price is going to go up. That's not always the case. You know, I'm curious, guys. I'm going to ask ChatGPT, what are the best stocks to buy now? Dividend. Best dividend. There we go. We're going to see what ChatGPT thinks, guys. I know you're not a real analyst. Just give me a list. Best 5 stocks to buy now. Come on. Provide me the info. 5 stock recommendations. This is something that's changed. It just straight up will not spit out 5 stocks. I've done this in the past, I've thought. Is this something they changed with ChatGPT? It's refusing, just straight up. Five. I don't even know what's its deal. Maybe I have to write that out like that. 5 stocks. Yeah, it's just straight up refusing. Huh. Weird. Oh no, it did spit something out. Let's see here. However, I can suggest some well-known and historically strong companies that you might consider researching further. Keep in mind that you should perform your own research. Blah, 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 blah. So, ChatGPT is recommending Apple, Microsoft, J&J, Procter & Gamble, and Visa. They're pretty solid 5. It's a pretty solid little list. Can't hate on them for those recommendations. Again, it was just refusing for the longest time, which I thought was kind of weird. Yeah, it's not a bad list. It just took me a minute to get to the list. Or some other weird stuff that we can ask it. Should I sell my MasterCard stock? Whenever you sell your MasterCard stock or any other investment, despite on various factors including investment goal, risk tolerance, and current financial health outlook of the company. Review your investment goal, assess the company's fundamentals, diversification. No. No. I don't want to diversify. Bad Chat GPT. It really kind of is. Random stock market fact. Tell me a random stock market fact. The New York Stock Exchange is one of the largest, most well-known stock exchanges globally. It was founded in 1792, when 24 stockbrokers signed the Buttonwood Agreement under the Buttonwood Tree. The agreement marked the beginning of the organized securities trading. And oh my God, I didn't know that. That's kind of neat. Tell me more. Tell me more. So, investing began in 1792. That's pretty cool. Look at that. We all did learn today. I hope everybody's having a good morning. So this is my portfolio. I will share us with you. How everything's looking. I have a very strong cord satellite position, I feel. It's worked very well for me so far this year. I know SCHD hasn't been the sexiest holding, but nonetheless I like it. It's something that will absolutely can just reinvest into itself over time. And I like all these holdings. I like them a lot. I'm a big energy drinker, probably more than what I should be. I betrayed Celsius. I'm actually drinking a Monster this morning, so I'm sure that probably makes them upset. But yeah, I don't know. I think I've got a good mix here. Again, I don't want to really over diversify or diversification, as Peter Lynch would say. I like to be nice and condensed with my holdings. Less than 10, no more than 10 at all times. That's including the ETF. That's kind of how I just want to rock things out going forward. Right now, I just need Hershey to get back on the saddle. They're my biggest down position right now. It's really my only red position. I'm down less than $2 in my SCHD, and I've got thousands of dollars in it. I'm not upset about that. Yeah, Hershey's really dropping the ball for me so far this year, but I like the company. They were at 270. Oh, excuse me. I watched them drop 250s, and they kept dropping 230s, and I was like, and they hit the 220s. I jumped into 220s, and I've just been, as it's dropping down, I've been averaging down, and my average buy price right now is 214. And if this was to dip into the 180s for any reason, I would probably buy more Hershey, even though my Hershey position's now more than my MasterCard. I like the company. It's got a great history behind it and a heck of a moat. I know that a lot of people are saying that the Mr. Beast is hitting them pretty hard. I love Mr. Beast, but I don't think he's got anything excuse me, on Hershey company as a whole. They're just too big. $39 billion market cap. And just look at this growth. Their debt's so well done. Love it. Love me some Hershey. So what's everybody into today? Anyone got any plans to run around, going around? Got any other stock recommendations? I can pop them into Qualtrim here. I can put them into the Dip Finder if you're curious about how they've been doing over a period of time. While we're sitting here, I'll type in Hershey here and just see how Hershey's been doing compared to the S&P. We'll look over the last 10 years. Oh, I put none. I meant to put that. It's actually trailing the S&P 500. It was ahead of it, and then they had that big drop. I don't know. I like them long term still. I hold SCHD, Hershey, Apple. I'm cost averaging down on my Hershey, waiting for the recession to cost average on all my holdings. I'm right there with you. I know that everyone is pretty certain that a recession is on the horizon. We can go over here and look at the Fed meeting hike meter thingy. I'm so technical with my terms. I'm so good at this. So if we look up to January, there's a small chance they do a rate cut in January. Why would they do a rate cut? I thought that Mr. J. Powell was stating that they're going to keep interest rates higher for longer, and those aren't dropping anytime soon, that we might get one by year's end. Let's look at March. There is a greater than, 63% chance that we have one, if not two, rate cuts by March. A market thinks that things are going to get awful next year. And the only thing that could force Jay Powell's hand to cut rates like this, one, a big negative domestic growth in Q1. GDP. There we go. Words are hard. But a big negative GDP report in Q1. And that would ultimately set us up for probably a Q1, Q2 recession next year. But I don't think it's going to be awful. I think it's going to be mild. My personal opinion, the economy is just so strong. I mean, unemployment right now is 3.7, 3.8%. So, I mean, it's still very, the job market's still very strong right now. But he's went from the little meter thing here. We went from one, maybe two rate cuts in 2024 to 1, 2, 3, 4, 5. There is a greater chance for 5 to 6 now. So yeah, something's gonna break next year. I don't know exactly what that is, but again, I'm in the same boat as you. I'm just holding on to what I've got in my portfolio. I'm letting it ride out. I'm reinvesting dividends when they pay them to me. This month's actually going to be a pretty good month. I'm going to be getting over $30 in just dividend payments just to sit on them. But I think next year's going to be a heck of a roller coaster. How about we look into ADP? I love ADP. Let's look into ADP. ADP is on my watch list, actually. This is automatic data processing, for those who don't know. This is like your HR payment processor type thingy. They've been around forever. They've increased their dividend. I'm wanting to say 50 years, if not over 50 years. Just a free cash flow yield, we got 3.15%, so it shows it's not incredibly overvalued. Dividend yield's 2.4%, payout ratio is 59%, so not bad. Revenue growth, 4.68% over the last 10 years, but it is growing quicker here recently, right at 6% over the last 5. You can see here things are picking up again for them. I like that. Free cash flow, 10.88% over the last 10 years. Again, we like to see double-digit free cash flow growth out of our companies. EPS, 11% earnings per share growth. And again, with this one, same situation. It's growing quicker. Over the last 5 years, 17.5%. It's a big difference. They have a beautiful balance sheet. They have right at $3 billion in debt. Their EBITDA is $5.26 billion. So honestly, if they wanted to, they could pay off all their debt with their EBITDA and be perfectly fine. They've got a lot of cash on hand as well, which I love. And the dividend, 13.87% dividend growth over the last 10 years. And here recently, things are accelerating. They're increasing their dividend hikes more and more. Again, love to see that. Shares outstanding. They've been buying back shares consistently, 1.57% over the last 10 years. And you want your companies doing that. The more shares they buy back, the more your one share counts. You get a bigger and bigger piece of that pie. And the return on capital employed, it's just been silly forever. It's over 50%. This looks like MasterCard, to be honest. It's that good. And when it comes to competition, I think really Paychex, I think it's really their only big competition. But I love ADP. I missed the opportunity because it dipped down. Was it beginning of the last month at 210? It completely flew under the radar for me. I would have jumped all over this if it drops again. This will definitely be one I'll be looking to add to the portfolio. Let's look at the dividend reinvestment calculator here. We're going to compare it to the SP 500. We're going to go back last 20 years. Look at this. Over the last 20 years, ADP has been growing at a rate of 12.43% with dividends reinvested. S&P 500 is right at 10%. So you're getting a market-beating growth plus dividend reinvestments. It just makes it even sweeter. It's just such a good company. So strong, too strong. I really like ADP. Your dollar cost averaging in the ADP, they just seem so solid. It's very solid. It's a great company. Again, it's just one of those, there's not that much competition around them. And I think most companies in the United States use ADP for their jobs. I think, like I said, I think their next, their competitions, I think it's called Paychex. Yeah, I think this is their direct comp. I mean, it doesn't look bad neither. Take a look at Paychex real quick since we just looked at ADP. Over the last 5 years, 78%. Just a free cash flow yield's right at 4%. So it's supposedly on a better price, better deal. This had a recent dip down to 108. It's already up to 123, so it's a good 10-15% jump pretty quickly. Maybe ADP and Paychex can have the same dynamic as MasterCard and Visa. Maybe. Like the two top dogs in that industry, probably, to be honest. I haven't looked into Paychex all that much. I just knew of them. I knew that that's like kind of direct competition with ADP. Revenue growth right at 8% over the last 10 years. That's nice. Free cash flow 10.4% over the last 10 years. Again, very nice. We're going to check comp. Stock-based comp is not an issue. EPS 10.6% over the last 10 years. Oh, this is beautiful. They have more cash than debt. I love that. Too good. You really can't. That's the thing. You can't really go wrong with either. Dividend, 9.78% growth over the last 10 years. Their last couple hikes have been more, 16%. So very similar story to APD. Shares outstanding. The only difference is they don't buy back their shares. It's looking like. Their CapEx isn't growing, which is nice. So that means they're not having to spend more money to make more money. If like that's it, little stock tip for you. Again, not financial advice. Always doing research. Disclaimers. If you're looking at a company when you're doing research, if you're seeing their CapEx go up 10% and their revenue is only going up 8%, that means they're having to spend more money to make more money, but it's not evening out for them. If you look here, their capex 154, 123, 127, 114, 132, 143. There's not really any growth there, so it's not an issue because their capex isn't going up or down, but their revenue and their free cash flow is going up. So they are spending the same amount of money essentially to make more money. You want that. You definitely want that. And again, return on capital employed. This is silly. 30s, 40s. Might be another one I put on the. Yeah, I'm gonna put this on the watch list too. I really like everything I seen just then. Was it PayX? I think it was PayX. I need to go through my watch list real quick actually and take some stuff off here. Get rid of this. I'm gonna get rid of CSX. I got my railroad I got my railroad company. I got CNI. I'm just gonna get rid of all the healthcare stuff. I was looking and thinking, but like I'm good. Okay, I think this is what we're gonna rock for right now for our watch list. Yep. I like this. Nice and manageable. Yeah, I'll see if Paychex goes on any dips. I will absolutely give them another look. That's a fundamentally a really good looking company. Liked it. Yo. I'm glad that a lot of the real estate companies and stocks and stuff are starting to turn back around. Extra space storage is being the big winner for me. I'm now green in this company, and if you haven't checked out my last couple of portfolio updates, I was down big time on this at one point. I'm in the green now, but at one point I was down 26% on extra space storage, but I held on. As it was dropping, I was buying more, and I'm now in the positive with it. And I think that this is just going to, as the feds are decreasing interest rates, debt on real estate is going to go down, and I feel like REITs are going to take off. My personal opinion. APD is something I'm watching. APD. That's Air Products and Chemicals, I think. Here, take a look at it. APD. Yep, Air Products and Chemicals. Oof, what happened? Whoa, they have what is going on here? 1, 2, 3, 4 quarters of negative free cash flow? It looks like their capex is going up and up and up. I mean, there's a lot of news articles are pushing it. This scares me though. If this tells me the company's bleeding money. Something's going on with management. Because if the issue here, their EBITDA is growing, their revenue is staying basically the same, but their free cash flow is decreasing. Did they do an acquisition or something, or did they do something aggressive? I mean, they took out a lot more debt this year. It's still very manageable though. It's nowhere near 3 times. 67% payout ratio. Yeah, I mean, it's a little on the high side, but it's not terrible. My only concern is the negative free cash flow. I mean, everything else looks fine. with the company. It's just that negative free cash flow is kind of scary. How long have they been increasing their dividend? ADP dividend. Oh, excuse me. Nope, not ADP. APD. APD. There we go. There we go. Click that. 48 years. I mean, they've been doing it for a while. They've increased that dividend through some wars during that time, financial crisis, .com bubble, COVID. They've been able to consistently increase that dividend. Double-digit rate over the last 10 years, 10.3%. EPS is still growing. I mean, it's I don't know a whole lot about them. So like I don't know why they've got the negative free cash flow over the last couple quarters. I don't know if you know or not, Sean. Let me know what's going on with them. But I mean, besides that, I mean, the company doesn't look terrible. They got good debt to EBITDA management. It's just, again, it's just that free cash flow is kind of scary. And their CapEx is growing. But there are news articles here stating that it is a sleep well at night. Yeah, I don't know what's going on with it. Either or, though. EPD. Yeah. So does any of you own any REITs? Because I know a lot of REITs have been jumping. The dividend growth did look pretty nice. It was 8 to 10% dividend growth over the last 10 years. I mean, you can't just look at that. Just Vici. I mean, just Vici, but Vici's really good, especially if you were buying it or adding on when it was down to $27, $28. You also got some Vici. Good. How are you doing, Miso? Hopefully you're having a great Sunday. But yeah, a lot of real estates are doing fairly well. Hey, Kevin. You have Realty Income, MPW, OHI, NHI, EPRT. MPW's had such a rough year. I'm hoping that they can turn things around. I know a lot of people own this. American Towers is on your watch list. AMT is good. AMT is very good. AMT is genuinely a market-beating REIT. My favorite is ABR Arbor Realty. I think I seen a video on Arbor Realty Trust from the Dividend Bull. He does a lot of high dividend yield investing. I mean, it was interesting because apparently they've got some things going on from a corporate level, but it's nothing to really worry about all that much. CEO makes a massive purchase. I mean, if CEOs are buying their own stuff, yeah. You like insider ownership. You own American Tower Corp as well? Yeah, I mean, American Tower Corp's pretty good. One of the biggest cell phone tower REITs. And I think they're international too. That's the difference between AMT and Crown Castle. I think Crown Castle's only in the United States. And AMT is pretty much everywhere.
Crown Castle's derelicts and AMT's pretty good shape from what I've seen, like in person.
Yeah, they're both doing really good. And they had some dips here recently because pretty much every REIT did because of interest rate scares, but they're getting right back on track with everything. OHI and HNI are both crossover plays for me with the healthcare sector in hospitals and nursing homes. OHI is another one that I've seen come up quite a few times. I know, yeah, it's having a good year, 14.8% up. 8% dividend yield. Whoa, that's pretty high. But yeah, I've heard quite a few things from OHI, and you said the other one's HNI. Let's see what we got going on there. HNI Corporation up 37% year to date. That's awesome. And it's very quickly, guys. After the stream, if you haven't, if you could, would greatly appreciate it. If you aren't subbed, please hit that button, like the stream, and I've uploaded my Sunday video. So if you could go check it out, check out my Friday upload too. If you haven't, it would mean a lot, and I would greatly appreciate it. Tortoise, I got to get to work. Fun chatting with you, man. I'll try to catch you next time. Oh, absolutely. I'm gonna try and do another little stream later on tonight. I'm testing the waters, seeing if the mornings or the night-ish area works best. So I think it's around 8 o'clock tonight's when I'm going to try and do another little, maybe like an hour, just see if it's more active. But yeah, I hope you have a good day at work, man. I appreciate you dropping by. Take care. MPW. Yeah, MPW, they've had it's been a tough year for them. I know they announced a dividend cut. It's been a year for dividend cuts. Intel cut their dividend. MPW cut theirs. I think Walgreens is next up on the chopping list for chopping block for a dividend cut. It's just it's so high, and the stock price just keeps dropping and dropping and dropping. They cannot catch their footing. They're down 44% year to date. This one's been a tough one. These news articles are brutal. These two high dividend stocks will probably let you down. What are the two they're talking about? Wow, it's MPW and Walgreens. MPW, I think they're trying to get things sorted out, though. I know they've sold a couple of their sites to try and generate some more free cash flow. But out of those two, out of Walgreens or MPW, I would personally probably just own MPW. They've already done their cut, and they're already trying to get things back on track. But yeah, Walgreens has been destroyed this year. Super tough. I also think it's interesting to see what some of these news articles recommend. Especially the Motley Fool. Is a dividend cut imminent? I think so. MPW is super cheap. That is a bright side. I think it's below $6. Do you think MPW has hit the bottom? Let me see. 3 months. Looks like the last quarter they reported free cash flow is looking better. Revenue still slightly declining. I don't know. I mean, MPW for long-term hold. I could definitely see, they cut their dividends, so that's going to help them with their financials going forward. They did report the last quarter good free cash flow. I could see this whenever it dropped down to 408 being their ultimate bottom if they can get things back on track. And they'll just go right back in line with everything. Once interest rates start getting cut, I think it's going to help them a lot as well, along with pretty much every other REIT. But again, not financial advice, but I think the bottom was 408, and I think REITs are going to be doing pretty well going forward. Because again, like I said, interest rates are going to start getting cut. That's going to make their debt more manageable, and just overall, just going to be a lot better for them. I mean, it was really high at one point. Wasn't the dividend like 16% or something crazy? Oh, I feel old. So what is I'll go ahead and ask Jens, what are y'all's opinions on doing like morning streams on the weekends at 9 o'clock? Or would it be better to do like an evening stream on the weekends at like, let's say 8 at night, Central, of course? Is it better to do it in the mornings or the evenings? I want to hear y'all's feedback if you don't mind. Because I do want to do streams on the weekends. Because it is fun to just sit, chit chat, look through stuff with you. I do really enjoy that. Because I'm going to try to do another stream tonight around 8 Central, so it's going to be in about 10 hours, just to kind of test the waters and see if it's more or less active. Again, I have fun with these. I enjoy them. Morning. Just kind of like what we've been doing. Oh, excuse me. I mean, I don't mind doing either one. I have been doing them around 8:30 to 9 Central of the mornings, streaming at times that are different with others. Ryan put out his Sunday morning as you open this one. Maybe 11. Okay. Okay. So maybe do it a little bit later. I could definitely swing that. No problemo. I appreciate the feedback and stuff. I love Ryan. He's so neat. That dude is so cool. So, we all like mornings. Maybe start a little bit later, is what I'm seeing. I absolutely can do that going forward. That's no problem whatsoever. Every other hour. I can't stream that much. I'm wanting to game a little bit. Probably here in a little while. Fire up a couple video games. I might go play some Pokemon Go later. I don't know. I know I have to go back to work tomorrow, and I'm just like, I don't want. but it's all good. So from what I'm seeing from ins like the mornings start maybe a little bit later. I can absolutely do that. Well, I think I'm going to end it there, guys. I do appreciate the feedback a lot. I have no issue streaming of the mornings, like you said. If 11 o'clock sounds good going forward, we can start doing that. Saturdays, Sundays, I will make a post in my community tab for just verification of when I'm going to be going up. Again, if you haven't, make sure to go check out my Friday video, how many stocks to hold in your portfolio, and I uploaded a new one a while ago. 3 dividend stocks to buy and hold forever. I greatly appreciate the support, and it just helps. Like, even doing live streams and stuff helps with the watch times on YouTube, and it's fun. I really do enjoy this. But yeah, I think I'm gonna end it, guys. Again, if you guys could go check those out, drop them a like. I would greatly appreciate it. And yeah, going forward, I'll make a post on the community tab. We can start a little bit later, as you said, Kevin. Maybe around 11 a.m. Central, or 10 a.m. Central, 11 your time. I don't know what time would be best. But yeah, yins all have a great evening, and I will talk to yins later. See yins.